Welcome to Smart Tech and Finance. Today, we start a brand new journey to become a professional trader in the financial markets. Many dream of achieving financial freedom through trading, but without proper knowledge, the market can be an extremely unforgiving and harsh place. To succeed, you must understand the language of the market. This is where technical analysis comes into play for every single investor. Technical analysis is the study of historical market data, primarily focusing on price and volume, to forecast future price direction. By analyzing past price movements, traders can identify patterns that tend to repeat, giving them a statistical edge in their daily. It is not about predicting the future with absolute certainty, but rather about managing probabilities and making highly informed financial decisions. Whether you are trading traditional stocks, global forex, or volatile cryptocurrency, the principles of technical analysis remain universal. The ultimate goal is to pinpoint the optimal times to buy or sell, maximizing your potential profits while strictly minimizing potential. Before diving deep into complex indicators, we must first understand the most fundamental building block of technical analysis, which is price is not just a random number on a screen. It is a direct reflection of human psychology and overall market sentiment. Every single transaction represents a constant battle between buyers and sellers, driven primarily by the powerful emotions of when buyers are more aggressive than sellers, the price goes up. Conversely, when sellers dominate the market, the price will inevitably fall. To truly comprehend price action, we need to monitor 4 critical data points during any given trading period, regardless of the time. These 4 points are the opening price, the closing price, the highest price reached, and the lowest price recorded during the period. The opening price marks the beginning of the battle, setting the initial tone for the trading session and establishing early market sentiment. The closing price is arguably the most important, as it represents the final consensus between buyers and sellers at the session end. The highest and lowest prices show the extreme limits of market volatility, revealing how far emotions pushed the value during the session. To visualize these 4 crucial price points effectively, traders rely heavily on a specific type of graph called the Japanese. Developed centuries ago by Japanese rice merchants, this charting method has become the absolute gold standard for modern financial market tech. A candlestick chart provides a wealth of visual information at a glance, making it far superior to a simple standard line chart. Let us break down the anatomy of a single Japanese candlestick to understand exactly what it is telling us about the market. Every standard candlestick consists of 2 main components, the solid central body and the thin lines extending from it. The main body of the candle represents the crucial price range between the opening and the closing prices for that specific period. If the closing price is higher than the opening price, the body is typically colored green, indicating a positive or bullish session. A green candle clearly shows that the buyers were in control, successfully pushing the asset value higher by the end of trading. Conversely, if the closing price falls below the opening price, the body is colored red, signaling a negative or bearish. A red candle vividly illustrates that the sellers dominated the market, forcing the asset price downward before the trading period finally. The wicks, also known as shadows, extend above and below the solid body, showing the absolute highest and lowest price. The upper wick indicates the peak price buyers managed to achieve before sellers pushed back, revealing a temporary surge in. The lower wick shows the absolute lowest point the price dropped to before buyers stepped in to support the market from falling. By carefully observing the size of the body and the length of the wicks, traders can accurately gauge the underlying market momentum. A long green body with very short wicks suggests strong and decisive buying pressure, with bulls maintaining firm control. A long red body with minimal wicks indicates overwhelming selling pressure, meaning the bears dominated the market from start to finish. Now that we understand the basic anatomy, let us explore some specific candlestick patterns that professional traders use to make profitable decisions. One of the most powerful single candle formations is the marubozu, a Japanese term translating to a bald or shaven head complete. A true marubozu candle has a very long, solid body and absolutely no wicks on either the top or the bottom side. A green marubozu means buyers controlled the price from the very first second of the session right up until the final bell. This indicates extreme bullish momentum, suggesting that the upward trend is highly likely to continue strongly into the next several trading. On the other hand, a red Marubozu shows that sellers were in absolute command, driving the price down relentlessly without any hesitation. Seeing a red Marubozu is a strong warning sign for investors, as it often precedes further significant declines in the asset price. Another incredibly important and common candlestick pattern you will frequently encounter on your trading charts is the mysterious and highly debated. A doji is formed when the opening and closing prices are virtually identical, resulting in a candle with almost no real body. It typically features long upper and lower wicks, visually representing a fierce tug-of-war between aggressive buyers and equal. The doji perfectly illustrates a state of absolute market indecision, where neither the bulls nor the bears could gain a decisive. While a doji alone does not guarantee a reversal, it strongly suggests that the current prevailing trend may be losing its momentum. If a doji appears after a prolonged uptrend, it serves as a critical warning that buying pressure is finally starting to fade. Smart traders will often use this specific signal to tighten their stop losses or take some excellent profits off the trading table. Candlesticks become even more powerful when we look at them in combinations of 2 or 3, forming complex and highly reliable patterns. One classic 3-candle reversal pattern that every aspiring trader must learn to recognize is known universally as the evening star. The evening star typically occurs at the very peak of an established uptrend, signaling a potential and often dramatic shift in momentum. The first part of this pattern is a large green candle, confirming that the bulls are still currently in control of price. The second candle is usually a small-bodied candle, or a doji, indicating that the strong bullish momentum has suddenly completely halted. Finally, the third candle is a large red one that closes deeply into the body of the very first green bullish candle. This decisive third candle confirms that the bears have successfully seized control, and a significant downward reversal is now officially underway. Recognizing the evening star early allows savvy traders to exit their long positions and potentially open short trades to profit from. There is also a bullish counterpart to this pattern known as the morning star, which signals a reversal at the market bottom. The morning star begins with a strong red candle, followed by a small indecision candle, and concludes with a powerful green surge. These patterns are just the absolute tip of the iceberg when it comes to the vast and fascinating world of technical analysis. As a beginner, it is crucial to spend countless hours simply staring at these charts, training your eyes to spot these formations. You must remember that no single candlestick pattern is ever 100% accurate. They are merely probabilities based on historical data. Professional traders always combine candlestick analysis with other technical tools, like support, resistance, and volume to validate. Volume is especially critical, as a pattern accompanied by high trading volume carries significantly more weight than one with very low participation. Another vital aspect of becoming a pro trader is mastering the psychological discipline required to stick to your meticulously crafted. The market will constantly test your patience and emotional stability, tempting you to make impulsive decisions based on sudden fear. When you see a massive green candle forming, the fear of missing out can strongly urge you to buy at the top. Conversely, a sudden plunge and a giant red candle can trigger panic selling, often causing you to exit right at the bottom. Technical analysis provides a logical framework that helps you ignore these destructive emotions and trade based on objective, quantifiable market data instead. It allows you to define your exact entry points, profit targets, and stop-loss levels before you even enter a risky trade. Risk management is the true secret weapon of professional traders. It is what keeps them in the game during inevitable losing streaks. You should never risk more than a small percentage of your total trading capital on any single trade, regardless of the setup. Even the most perfect Marubozu or evening star pattern can fail unexpectedly due to sudden macroeconomic news or unpredictable global market. Therefore, always strictly use stop-loss orders to automatically close your position if the market moves against your initial technical analysis. As we continue this comprehensive educational series, we will delve into more advanced concepts concepts like moving averages, RSI. But for now, your primary homework is to open a trading platform and practice identifying the basic candlestick structures we discussed. Look for green and red bodies, examine the wicks, and try to understand the story of the battle between buyers and sellers. Can you spot a doji signaling indecision, or a powerful marubozu indicating a strong continuation of the current market trend? The more you practice reading these visual cues, the more intuitive the process will become, eventually feeling like a second-nature skill. Remember that every master trader was once a complete beginner who struggled to understand these seemingly chaotic red and green lines. Success in trading requires unwavering dedication, continuous learning, and the ability to adapt swiftly to ever-changing global finance. Do not rush the learning process. Take your time to build a rock-solid foundation of knowledge before risking your real money. Many beginners make the fatal mistake of treating the financial markets like a casino, gambling blindly without any proper technical analysis. By taking the time to learn how to read Japanese candlesticks, you are already stepping far ahead of the average retail investor. You are learning to see the hidden footprints left by massive institutional investors and smart money moving billions of dollars every day. Large players cannot hide their activities entirely. Their massive trades inevitably leave distinct marks on the candlestick charts for us to analyze. Our job as independent traders is to identify these massive institutional footprints and ride the powerful waves they create in the market. This requires patience, as the best trading opportunities do not appear every single minute. Sometimes the best action is waiting for the perfect candlestick setup at a key level of support or resistance dramatically increases your overall probability of trading success. Let us quickly review the core concepts we have covered in this foundational lesson on technical analysis and Japanese candlestick chart reading. Technical analysis uses past price data to forecast future movements, helping us find the best possible moments to enter, and price is the ultimate indicator, reflecting the collective psychology, fear, and greed of all participants currently active in the global. We track 4 essential price points for any given period: the open, the close, the highest peak, and the absolute lowest. Japanese candlestick charts provide a superior visual representation of these 4 points, making it incredibly easy to digest complex. The solid body of the candle shows the crucial distance between the opening and closing prices during that specific time frame measured. Green candles indicate bullish dominance and rising prices, while red candles signify bearish control and falling prices. The wicks or shadows reveal the extreme highs and lows, showing us exactly how far the intraday battle pushed the asset. We learned about the marubozu, a powerful wickless candle that demonstrates overwhelming momentum in one specific direction. We also examined the doji, a cross-shaped candle that perfectly illustrates market indecision and a potential exhaustion. Furthermore, we explored the evening star, a highly reliable 3-candle pattern that frequently warns of an impending bearish reversal. Armed with this fundamental knowledge, you are now much better equipped to analyze charts and understand the underlying narrative of price. In our next lesson, we will build upon this foundation by introducing trend lines and identifying crucial zones of market support and resistance. We will learn how to combine these new concepts with our candlestick knowledge to discover high-probability, low-risk trading setups daily. Until then, keep your charts open, stay curious, and never stop analyzing the fascinating psychological battles playing out on your. Trading is a marathon, not a sprint, and mastering technical analysis is a lifelong journey of continuous improvement and endless Embrace the learning curve. Accept your inevitable mistakes as valuable lessons, and always prioritize strict risk management. The dream of becoming a professional trader is entirely achievable if you commit to discipline, education, and unwavering emotional. Thank you for joining us in this first critical step toward mastering the financial markets and taking full control of your future. We hope this introduction to technical analysis and candlestick charts has provided you with immense value and clarity on your trading journey. If you found this lesson helpful, please make sure to like the video and share it with fellow aspiring traders and friends. Your support helps us create more educational content to guide you safely through the complex world of modern global financial market trade. Do not forget to hit that subscribe button and turn on notifications so you never miss our upcoming advanced technical analysis tutorials. Leave a comment below with any questions you have about candlesticks, and we will be happy to help you understand them better. This is Smart Tech and Finance signing off. Stay disciplined, trade smart, and we will see you in the next educational video.